Hello, everyone. I'm so excited to be interviewing Dalia Barzam, founder and CEO of Streetwise Mortgages. Her and her team have decades and decades and decades of experience helping real estate investors buy multiple rental properties and scale their real estate portfolio. So in today's video, we're going to talk about the 3 tips you can do right now, 3 actionable steps you can do right now to help manage your real estate portfolio in this housing market correction. We're also going to talk about the changes to the readvanceable mortgages, which is going to take effect into 2023, and there are actually ways to mitigate this new change in 2023. So we're going to do all that. So if you are a real estate investor in Canada, or you're an aspiring real estate investor looking to buy your first or next rental property, then you definitely want to check out today's video. Hi, Dalia. So we're in a crazy market today. We've got early signs of recession. We've got a lot of real estate investors, probably, maybe this is the first time they're seeing this, where markets are changing. I'm seeing in Ottawa housing prices actually slowing down. I even seen price decreases, which is like, wow. Like I'm actually happy as a real estate investor, because I think there's going to be potential more and more opportunities in the upcoming years. But I think for a lot of real estate investors, they're new to this market. So Dalia, why don't you help me out? Let's talk about the tips that you advise real estate investors to tackle in this type of market.
Yeah, so Tracy, definitely the market is changing, and here is the thing that I believe in. It does seem like the sky is falling, and the media is making it sound like we're heading to a recession and the sky is falling. But for real estate investors, the market ahead is an opportunity. Why is it an opportunity? Because now you can pick up properties at better prices. And yes, the rates are going up, but if you plan, there are more opportunities for you to pick up. And there are properties that will now cash flow, versus previously you were paying 100,000 above, 150 above, competing against gazillion people. So everybody needs to calm down and breathe. Number one. So let's talk about what's ahead and how do we plan for it. So first of all, the rates are rising. The Bank of Canada is going to increase the rate again. Everybody should be prepared for at least another 1% increase by the end of this year if they're in a variable rate mortgage. You don't need to panic. Yes, your payments are going to go up if you are in a product that fluctuates, but don't panic. Here is why. It's because the bank will not continue to raise the rates forever. Typically, what happens is that once they get a handle on inflation, they start to stabilize and pull their feet off the gas, and the rates will come down. So if you can stomach the rate increase and you've stress tested your portfolio, the way you handle it is to say, okay, I know exactly how my payments are going to go up. I am okay. Or my payments are going to go up. Where else can I save? Maybe we can clear that in certain areas of your budget. Maybe we can re-amortize certain loans and open up capacity. Or maybe you lock into a 1 or a 2 year fixed temporarily. Don't go into a 5 year. It's massively higher, but lock into a 1 or a 2 year until this cycle stabilizes. So that's on the rate front. On property values, we're starting to see prices soften in some markets. We're starting to see conditions and offers again. So here is what you need to consider as a real estate investor when it comes to the values of properties. One, if you are investing in a BRRRR and you are in the midst of renovation right now, and you are projecting to take out money at value this high, well, I would say let's plan for a lower value and see how the numbers play out. And let's look at that now versus later when the time comes. Maybe there are certain things that you don't want to renovate anymore because you're not going to be able to recapture that equity upside compared to an aggressive market we used to be in. So for those who are investing in the BRRRR, we need to plan differently now for exit.
Oh, just a pause a second, Dalia. Thanks for talking about the BRRRR. I think just for some people, they may not know what the BRRRR is. So let's talk about you're talking about buying a place, then renovating it, then refinancing the property. So you take out the cash or a part of the down payment that you put in, and then renting it out, right? Is that what you're talking about? Is the BRRRR method? Okay, cool.
Yeah, thanks for clarifying that.
Mhm.
And the key to the BRRRR method is as you renovate, you're pushing the value up. So when you refinance, you are taking out that equity to pay yourself back for the money you invested into the deal. And now that the market is softer, these values are expected to be lower than what some investors may have anticipated. So we need to plan for what that new exit looks like now. If you're buying properties, welcome to conditions of financing. We're back into conditions of financing. Put your offers in with conditions. Make sure that you have a financing condition, if not a financing condition, an appraisal condition, because the market is changing literally. Like I'm finding this changing fast, and you don't want to be in a position where you overpay. So that's on the value front. And then on the qualification front, things are also changing.
What?
Yeah. So here's the thing: as the rates rise, the qualification bar rises, which means if you want to take out money, you may take out less. If you're buying, you may qualify for less. So how do you get around that? You get around it by planning with your mortgage advisor. Where do you maneuver to actually qualify better? Meaning, maybe we need to clear some debts. Maybe we need to accept a higher rate in some cases to qualify for more. But you need to have that discussion early on, because the bar is going to continue to rise. And if you're looking to take out money or invest, we got to be ahead of that wave versus deal with it when the time comes. And then there are some changes to the lending rules in terms of line of credit products. Just last week, the banking regulator changed the rules around what's called advanceable mortgages. Do you want me to explain briefly what an advanceable mortgage is?
Yes, that'd be greatly appreciated. I think some people are familiar with the product HELOCs, right? A home equity line of credit. That's a readvanceable mortgage product, right?
Well, it is a HELOC, but it's a dynamic HELOC. As you pay down the mortgage, your HELOC increases in its limit. And that was a beautiful feature for investors, because you don't have to refinance to tap into any mortgage pay down. It used to increase automatically. So what the regulator did last week is they said, effective 2023, you can only advance anything above 65%. So let's say you have a mortgage with a zero line of credit. In the past, it used to be as you pay down the mortgage, this line of credit increases. Now they're saying, no problem, pay down the mortgage, but you're not going to get any money back on the line until you've paid down 15% of that mortgage. That's when you start to reborrow the money. This may seem as a big limitation to investors, but the way to handle it is to restructure how much line of credit money we take versus how much mortgage we take. So I just wanted to let investors know that this is coming in 2023. If they are in an advanceable mortgage product right now, they will be impacted at the time of the renewal. If anybody is applying for it for the first time, the new rules will kick in. So how do we get around it? We just have a discussion about how much mortgage we take versus a line of credit so that we don't lose out on this feature.
Right. Okay. So you're saying that there's new changes in that, and it's 2023 and applies to existing readvanceable mortgages and new readvanceable mortgages. So no one's kind of getting out of this. And what I'm hearing is that if you want to, I guess, get access to more equity, sounds like you'd have to requalify for that, right? Upon refi, like if say for, I'm just thinking of my example, like if I have a readvanceable mortgage, it's fine for now, okay, 2023, but upon renewal of my mortgage, will they ask me to completely qualify for this or no? Okay.
But what's going to change is there right now, as you pay down the mortgage, your line is increasing.
Yeah.
For every dollar you put here to pay down principal, the line is increasing. When your renewal comes up, there is no requalification. You're going to keep the product, but if what you're paying down is more than 65% of the total loan you have, that has to go back to paying down the loan. It will stop moving to this side of the equation.
Okay, and this is in effect in 2023. So could there be I guess suggestion, like if someone wants to like pay a big proportion of the mortgage, they should do it now and then still get access to that line of credit, like I guess this before 2023?
So 2023 is when this new rule is going to kick in for those who are applying from like for the product. If you're already in the product, you're not going to be impacted in 2023. You're going to be impacted when your mortgage renewal comes up.
Yeah.
So how do we get around it? Again, it's a matter of deciding, okay, how can we restructure what you have so that you've got 65% loan of the property value, so that anything you pay above that starts to go to the line, because the limit is on anything above the 65%. So to answer your question, should people do like a lump sum payment to the mortgage to get around it? No, it's really going to depend on, it's on a case-by-case basis. Let me put it this way.
Mm-hmm.
On a case-by-case basis. So to solve it, it's a matter of re-engineering the components of the product to continue to benefit from this advancing feature. Okay. And it's not a black or white rule. It's on a case-by-case basis. It has to be through a discussion. Because some client, restructuring it may not work. It depends on the situation.
Yeah, look out for the changes that are coming in 2023, and obviously have a discussion with a qualified mortgage broker who specializes in real estate investing. So, I mean, your team does this. So, where to find you, and how can you help real estate investors? I know you have a financing roadmap. That is so critical to this discussion.
We're providing a lot of guidance to investors at this point around whether or not to lock if we want to create cash flow in their portfolio, given the rates rising. How do we do that? We're talking about, again, restructuring some products to make sure they continue to benefit from the features that they signed up for. And just a lot of advice and guidance at these times, and a lot of planning. That's the key. And investors can reach us at info@streetwisemortgages.com for any questions or to set up a complimentary planning session. The key to this is to go into the cycle with confidence and running the numbers and knowing, hedging essentially. So you're not caught by surprise, you're not getting stressed, and it's just a ride up the mountain, and then it's gonna stabilize. So we're looking at 18 to 12 months, 18 to 24 months ahead, I would say.
Okay. Well, thank you so much, Dalia, for your time. This has been super, super helpful for all those real estate investors who are stressed out in this type of market. I hope you found this video super, super helpful. I'll see you next time, Dalia. Thank you.